Debt market update. FY24 proved to be a volatile year for global fixed income markets, particularly in advanced economies (AEs). Amidst synchronized tightening by major central banks worldwide, AEs witnessed significant swings in yields as both growth and inflation exceeded expectations. The year started on subdued note on background of US and European banking crisis, resulting in yields falling sharply. However, the quick response by AE's central banks nipped the crisis in the bud. The resilient economic activity, elevated inflation, and limited fallout of the banking crisis kept the US Fed and other major AE's central banks on path of continued rate hikes. However, in H2 FY24, easing inflation in the United States, coupled with dismal growth in Europe and the US Federal Reserve's pivot in December, yields declining substantially. However, this was reversed in Q4 FY24, as inflation, economic activity, and labor markets surprised significantly on the upside, and rate cuts expectations were pushed out to later in the year. By the end of the year, 10-year government bond yields in US and UK ended 73 bps and 44 bps higher than last year. However, Germany 10-year bond yields were largely flat as the growth overhang weighed on yields. Conversely, Indian government securities GSEC yields trended lower during FY24 and 10-year GSEC yields ended the year at 7.06%, 25 basis points lower. The curve flattened as long-end yields rallied, while short-end yields closed the year higher than the previous year. The announcement of inline market borrowing in the budget, coupled with an unexpected pause by the Reserve Bank of India (RBI) in April 2023, led to yields falling in the first half. However, elevated inflation, primarily driven by food prices, along with the draining of interbank liquidity by the RBI and the possibility of open market operations (OMO) sales to manage liquidity, resulted in rising yields in the second half at the short end, although yields at the long end remained range-bound. India's inclusion in global bond indices led to significant increase in FPI's flows post-September 2023, which capped any significant rise in yields at the long end. The corporate bond spreads were largely stable compared to the previous year. During the year, the average interbank liquidity experienced a significant decline, primarily driven by an increase in government cash balances, rise in currency in circulation, and open market operations (OMO) sales conducted by the RBI. This reduction in liquidity was partially mitigated by forex purchases carried out by the RBI. Foreign portfolio investors (FPIs), including those under the voluntary retention route, made debt investments totaling $14.2 billion in FY24, a noteworthy shift from the previous year, when there was a net sale of $0.4 billion in FY23. Approximately 80% of these flows occurred in H2 FY24, following the announcement of the inclusion of GSEC in JP Morgan's global bond indices. Credit markets remained largely stable throughout the year. Credit spreads, which had reached their low point in 2022, saw a modest increase in 2023 due to the expansion in corporate bond supply. However, these spreads still remained below historical averages as demand continued to be robust. RBI, in its recently concluded MPC on 5 April 2024, kept the policy rates unchanged at 6.5%, and stance remained focused on withdrawal of accommodation to ensure that inflation progressively aligns to the target, while supporting growth with a majority vote of 5-1. Outlook. In FY24, the Indian fixed income markets demonstrated relative stability, particularly in contrast to the high volatility witnessed in the debt markets of the US and other advanced economies. This resilience can be attributed to several factors, including a fiscal discipline, consistent demand from long-term buyers such as insurance and provident funds, easing core inflation, a correction in commodity prices, and a comfortable external sector characterized by ample forex reserves and an improving current account. The outlook for fixed income for FY25 remains favorable in view of the key drivers, which are: inclusion of India's sovereign securities in JP Morgan Bond Index bodes well for demand outlook for GSEC in next year, and can effectively cap any significant rise in yields. Core CPI momentum remains subdued on back of lower input price pressure and range-bound global commodity prices. Government reiterated its commitment of bringing down fiscal deficit to less than 4.5% of GDP by FY26. This should keep market borrowings within manageable levels. External sector likely to be supported by steady services exports and adequate foreign exchange reserves. Rate hike cycle in AEs has ended and expectations of rate cuts are high during the year. RBI is also likely to cut rates in second half of FY25, although we expect a shallow rate cut cycle. However, there are counterbalancing factors which can put upward pressure on yields, such as regular food price shocks can keep headline CPI elevated. Sustained growth momentum can result in core inflation reaccelerating. SLR holdings of the banking system is high and credit growth robust. Thus, incremental demand for GSECs is likely to remain muted. Recent rise in commodity prices, especially crude oil, sustaining due to escalation of geopolitical tensions leading to disruption in supply chain. Overall, in our view, yields are likely to trade with a downward bias and the long end of the yield curve is likely to outperform over the medium term. Thus, as highlighted in the past, for investors with a relatively longer investment horizon, it is a good time to increase allocation to longer duration funds in line with individual risk appetite. Further, given a flat yield curve and elevated short-term rates along with expectations of rate cuts in the coming year, one may also consider investment in short to medium duration debt funds. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.